Hello and welcome back to the Hairdresser Strong News. And what does it have to do with you? Today we got a bunch of interesting news, and some of it's pretty crazy. And I'm sure you all want to hear about how does this all going to impact you and your customers. All right, so why don't we just dive right in? And I'm going to share my screen, and I'm going to play a short video for you, and that's how we're going to get started. All right. Here we go.
First, sticking with the U.S., BlackRock's Whaley stays optimistic on stocks this year, writing, quote, "We still think U.S. equities can outperform in 2025, led by tech, even as Europe's strong start to the year. Yet, we broaden our risk on view, upgrading European stocks." I'm pleased to say that Wade joins us now, Chief Global Investment Strategist at BlackRock. Great to see you, Wade. On this itself, because it hasn't exactly played out this way. We've had 3 days of selling in the US. As you know, Europe is outperforming. Tech, Mag 7 is down on the year. What to you says that dynamic won't necessarily last?
What is really interesting is that after a very concentrated rally in US markets, US equity market in recent years, the world is set up a bit differently coming into 2025. The bar is quite high, so the US market needs to meet an ever rising bar, whereas for the rest of the world, Europe or China for that matter, actually just a few things, one of the few things needs to go right for sentiment to turn around, which is why we actually have seen a broadening out of the rally and a catch up for the rest of the world relative to the US. Now, having said that, let's look at the dimensions of US exceptionalism. We're talking about greater representation in tech, we're talking about greater fiscal spend, we're talking about energy independence, we're talking about deeper capital markets, more robust risk taking. I think the US is still leading in most, if not all, of these dimensions. The gap may be narrowing, but the US is still leading, which is why, as we kind of up our conviction towards the rest of the world, in this particular case, European equities, is not coming at the cost of US equities. We're still overweight US equities.
So it's not a zero sum. If we can tackle some of the list of the US exceptionalism, because it feels like that is something that is being questioned. Let's start with fiscal spend, because you look at Doge's efforts, and the read, at least from what the market is saying, is that so far the first things we're getting are growth negative from the Trump administration. Do you expect that to change?
Well, yes, those effort of cutting fiscal spend or else equal would translate into lower growth impulses. But we also know that the Trump administration would love a more robust growth environment. They're talking about 3% real growth target, maybe 2.5% is more realistic. But the bottom line is, if we want to focus on growth, then fiscal needs to be supported, and that is inflationary. And also, if we want to focus on closing or narrowing the trade balance and through tariffs, for example, so that means that tariffs gets imposed without FX proper FX adjustment. That is inflationary as well. So when we bring all of this together, a lot of the policies actually points to higher inflation. So when you say, Danny, it's not a zero sum game from a whole portfolio perspective, when we make these adjustments to our investment views, it is a zero sum game. It needs to be balanced somewhere. And we're actually lowering our conviction to long duration US treasuries to support the upgrade for European equities. Currently, US 10-year at just about 4.3% is underappreciating the high for longer inflationary environment that we're heading towards in our view.
Okay, so what does that all mean? So basically, she's saying that that's Whaley from BlackRock, and she's talking about how essentially that the US is expected to perform better than any place in the world. Now, that is only interesting and positive to you if you are a macro investor, right? I mean, I think that if I'm a macro investor and I'm investing in global stock markets and I'm buying commodities, gold, Bitcoin, then that is important. All this information is important, like what's going on in the world. Now, how does it impact us? How does it impact our businesses? Well, as you probably know, I'm in DC, and here in DC, on the greater DMV district, DC, Maryland, and Virginia metro area, I would say the whole tri-state area. Well, we are experiencing pretty big fallout, and a lot of customers are losing their jobs. We've had 7,000 people file unemployment since January. I think that number is actually up now. And so the local economy is going through a serious churn. Now, I'm going to share my screen and I'm going to give you some more news on the economy. Okay, so this is the Wall Street Journal, and it's the week ahead for foreign exchange bonds, focus on U.S. jobs. And so let's talk about the U.S. Non-farm payrolls data for February are due on Friday, so keep an eye out on that. So on Friday, you should be hearing about the news about interest rates and give you a heads up about where they're headed. Now, we've already had some data come in this year. January's data showed below consensus jobs growth, but also the unemployment rate falling to 4% from 4.1%, and wage growth edging up to 4.1 from 3.8. This supports the Federal Reserve's recent shift to a slower pace of rate cuts. So, if you've been watching the news or listening to me, I've been talking about how everybody's waiting for rate cuts to come down. So, if you want rate cuts to come down, then I need you to think about, what does that mean? Like, why do I need rate cuts to come down? Well, I want rate cuts to come down personally because I'd like to sell one of my properties. I'd like to buy another property. I would like to see the housing market heat up. And so if interest rates are coming down, then we could potentially see the economy kind of boost back up again. But as long as interest rates are being held high, we've talked about this many times, interest rates being held high just slows economic growth. It makes it harder to grow your business. It makes it harder to open a business. It makes it harder to buy a house. So, what are all the factors that are playing into inflation? I'm going to read a few more pieces. Investors await more signs of how the economy has been faring since the November election. They said U.S. money markets currently price in another 325 basis point rate reductions. However, now it says the money markets are pricing it in, but what I'm reading is inflation might not be coming down enough to get that many rate cuts this year. Well, it says by the middle of 2026, so maybe a rate cut by the end of the year. I don't know. We'll have to see. One key question will be the extent to which recent cuts to government jobs hit jobs data. These could pave the way for rate cuts, although they are expected to be evident just yet. Or sorry, they're not expected to be evident just yet. We think cuts to the federal government jobs will take at least another few months to become apparent in the data. So if you're not in the DMV like myself, and then you might not feel the impact of government job drops, and when no one really understands how this is going to impact the national economy. However, this is a really interesting piece of information. Let's just Google it right here live while I'm doing this, and let's just look and see what is. So where are we at? We're at we think government jobs. So what is the percentage of the economy contribution to federal government? There we go. Okay. So here we go. According to recent data, and looks like fiscal data, so this is legit. And Fred, according to recent data, the federal government contributes approximately 23% of all U.S. economy. So that means if you start gutting the government, the economy loses productivity. And if we lose productivity, then yeah, sure, you could make the argument that deregulation will accelerate other businesses, but not in a high inflationary, high rate environment. So that's what my opinion is about that. So I think we're still in very much a wait and see. So let's go here. All right, we got this is CBS News. The PCE report, the Fed's preferred inflation measure, is out, and here's what it says. So this is recent. This is February 28th. So this is yesterday. The Personal Consumption Expenditures Price Index, or the Federal Reserve's preferred inflation measure, rose 2.5% in January on an annual basis, matching economists' expectations. So when I'm reading this information, the way I read economic data is like this kind of stuff. It's like, okay, well, I don't care what the number is. I want to know, is it matching expectations? Because the entire market runs on confidence and predictability. So the people who make outsized bets and speculate about how to make big returns, they are moving outside of what's to be expected. So like if you actually want to like make quick money, this is not financial advice, but if a person wants to make quick money, they have to be able to get into a position in an investment before some sort of news or information or reality that causes the price of whatever you're investing in to go up significantly. Otherwise, everything is a long-term investment. It's like at the end of the day. So if like the majority of us are probably not in a position where we should be making big bets on things that are outside of standard investment strategy. So, for example, we start off with our emergency fund, and then once we get our emergency fund, and then of money, then we go and we start maxing out our Roth IRA, which I think is like $6,000 a year. And so, like, if we got our emergency fund, maybe say 6 months, and then we're maxing out our Roth IRA, then we should, and that Roth IRA money is probably best advised, and you could talk to a financial advisor, but I'm pretty confident that they'll advise you to buy the S&P 500, the NASDAQ, so basically buy the whole US stock market. So that means that this economist expectations is the piece that is most important. Okay, so let's keep going. So what economists are saying? Economists are saying that inflation rose at a mild pace in January, which offers some relief after a string of economic reports suggesting that inflation is heating up again. So, because that's what I'm reading, inflation is coming back, and January's data slows things down. Now, if you look into seeing what Americans are saying, this is how Americans are feeling. So this is where your customers and the information about your customer comes in. Like, how is your customer feeling about the economy? Well, according to this, it says that prices in the last few weeks have been going up. So the majority of people feel like things are not getting better or things are getting worse in terms of how much price is. How about this one? Is your income keeping up with inflation? Well, 77% of people say it's not. All of this is weighing on consumer sentiment and consumer buying habits. So if the customer is feeling these things, then we are all going to, if we're not already, I know in the DMV we're already seeing this fallout. And according to this news that I've been sharing with you, the rest of the country will likely feel it in a couple months. And let's see. Oh, financial situation. So this is interesting. So people's financial situation, half of the country says it's good, and just around half say it's bad. So that's interesting. So we're like literally kind of going teetering a little bit. Now, and then this is by income. Is your financial situation good? Well, it says here 50,000, if you make less than 50,000%, only 32% of you are saying it is good. If you make 50,000 dollars or less, then it says that 60% of you is saying it's bad. And if you make 50 to 100,000, the majority of people say it's good, but not by much, just a simple majority. And if you make over $100,000, then the majority of you are saying it's good. So this is important because the demographic of your clientele falls within this. I highly suggest you, if you're not watching this live or on Instagram or on YouTube and you're listening to this on podcast, you should definitely click the links and check out this data on the CBS article. I think it's really cool and really visual, and we'll post some of it as well. Okay, so how many of you expect the economy next year to be booming or growing? 34%. Holding steady, slowing in a recession is the majority. So the majority of people think that things are either going to stay the same or get worse, which if they stay the same, that's not necessarily a positive. Okay, percentage of people who are concerned about saving and buying extras. Do you think that we are an extra? Well, if you're in a luxury market, then you are maybe an extra, but it depends. Are you a luxury market, like an aspirational luxury? Like, do you sell to customers who want to pay more money and enter into the luxury space, or are aspiring to become more wealthy? Because that is a thing, and aspirational purchases are don't look like they're going to hold up. So you're either clientele is making the $100,000 or more. And I think that depends on where you live, because $100,000 in middle of nowhere, Nebraska versus in DC is a very different living experience. I'll tell you that. And so the percentage of people who are concerned about paying debts, paying for housing, and paying for goods is 50% or more of people are concerned about these things. So this is all weighing on consumer data. And I would love to hear from you. How is this impacting your business? And I'm gonna go with one last little piece to kind of sign off here. I found something in the space of employment. Gen Z isn't quiet quitting. They're rejecting outdated leadership. Yeah, okay. So let's see. Yeah, Salon Nova. Stylists are feeling it for sure. Yeah, I know. I know. We're definitely feeling it up here. We're going to be doing a community conversation soon about that. Okay, last news piece, and I'm going to let you go. Gen Z isn't quiet quitting. They're rejecting outdated leadership. So, as you know, the Hairdresser Strong Show started off really digging into the expectation gap between Gen Z rising stylists and salon owners. And we believe that we figured out the solution, and it is community. And if you want to know more about that, you can look at our website or check us out. But check this out. Okay, so if your company is losing Gen Z talent, chances are the problem isn't them, it's you. Now, no salon owner wants to hear this because we all spend so much time, and all the managers and all leadership, we spend so much time trying to do our best. And so we don't want to hear that we're not doing a good job. So, what I did is I dug into this and I found that what is the information we can actually use? Because I don't think any of you are bad leaders. I just think that we need to understand the psychology of the new talent coming in so that we can communicate and onboard them and train them and retain them successfully. So the real problem, leadership hasn't kept up. I think this is more accurate, not keeping up, than the title of outdated leadership. And now, maybe they mean the same thing or it's splitting hairs, the semantics, but Gen Z grew up amid economic uncertainty, social justice movements, and an increasing focus on mental health. They don't just want jobs, they want workplaces that prioritize psychological safety, transparency, and fairness. And yet many companies still cling to outdated management styles, rigid hierarchies, inconsistent expectations, and vague career paths. Well, that's the gospel we preach at Hairdresser Strong. So, all salon leadership should understand that having documentation for the intake and onboarding process is something that will be vital for increasing the odds of attracting new talent. And what I mean by that is every single thing about your business should be documented. Think of what it would be like to go work at, say, I don't know, like a Steven Starr restaurant, Le Diplomat. Or like imagine like Steven Starr is a known restaurateur that has very successful businesses. And one of the secrets to business, and especially the ability to scale, is documentation of all your processes. And you have internal processes, but then you also have be stuff that you can share externally. So you have two versions of this documentation about your business, what everybody's role is, how people come in, how people grow. And that's the biggest piece for the new talent is what is their path and can you make it something that is structured and something that they can work through, but something that they can do at their own pace and move faster or slower? Or do you have a rigid 1 year training program? That's really what we're talking about here. Now, I'd love to hear from you. What are your thoughts about this? This is the news. I love the fact that we get together. You'll be seeing more of this, and I really would like to hear how are you preparing and dealing with the fallout of the government and like the breakdown and the cuts and all this stuff and the tariffs and potential inflation creeping up in the short term. What is it going to do in the next few months? The rest of the country is going to feel some of what DC's feeling. Hopefully not as much. So talk to me. Want to hear from you. Tell me what you're doing. All right. And also, how are you updating your onboarding systems? All right. Leave a comment below. Shoot me a DM. Shoot me an email. Listen at hairdresserstrong.com. I'd love to hear from you. And I'll talk to y'all later.